Good morning, everyone, and welcome to our special presentation of the magic of long-term trading and leaps. We're glad you can join us. My name is Raul Aurora. I'm the coaching and education coordinator here at Trading Wins, and it's always my pleasure to host these sessions with our head trader, Vince Vora, whom we will bring in shortly. Wanted to make sure that, first of all, you can all hear us and see us correctly. You should see a disclaimer slide on your screen, and you should be able to hear my voice. If you can, please let me know by putting in a note in your chat box. I see Richard, NoCal. Richard, nice to see you. I'm assuming that you're still in town and haven't left for your holiday, as you had told us yesterday. Nice to see Russell as well. Banu, nice to see you. I think you were on in the morning session too. Excuse me. Wynn, nice to see you. Susan, nice to see you as well. Glad you'll be joining us at the Super Conference in December as well. Richard, you were the first one in. David in Indiana second. Victor was third. All right. Vince, good morning to you. How are you?
I'm doing well, thank you. Good morning.
Great to hear. Now, yesterday you had mentioned that today is a shortened day in the markets, and by the time we would come on, the markets would be closed. Why don't we take a look and see what happened today?
Yeah, you know, it was interesting. It was very quiet the whole morning, and right at the close now, we sold off. So the Dow is down 153 points or so. Let me try to bring this up. There's that flush into the close. The Nasdaq down 65 today. The S&P down 13. And it looks like the Russell held on to a gain of about 5 points or so. But yeah, it was very, very quiet. And then right near the end, we got a bit of a rinse. I guess people don't want to be long over the next day or so. I mean, it wasn't a dramatic drop. Let's put it in perspective. It wasn't that horrible, but we did see about 100 points sell off in the last half hour or so.
We spoke in the session this morning about this being the halfway mark of the year and people reassessing or assessing how they've done in the first part of the year.
Yeah.
I wanted you to talk a little bit about the importance of having a longer term perspective, whether you're an active trader or whether you're what you classify as an investor. What's the importance of having a longer term outlook?
Well, there's a couple of points here. Number one, when you're trading with technicals, the higher the time frame, the more consistent the signals are. So I think it's not only easier because you have time on your side as a trader, but as a technician, it's just much easier to read. The charts are smoother. There's a lot less back and forth, and it's just more predictable, easier to read, easier to actually trade on the higher time frames. It also involves a lot less time, a lot less of your time if you're working full time, raising a family, have your own business, whatever it is that keeps you away from your terminal. When you're trading on a monthly time frame or even a weekly time frame, it really doesn't take a whole lot of time. But as history has taught us, when you have time on your side, it's a good thing, and you see some pretty significant moves. So the other benefit is the size of profit per trade that you can achieve on a higher time frame. So there are many benefits, and we're going to go through quite a few little techniques and different ways that you can trade the longer time frames today.
All right. The format of the session, as always, will be interactive. If you have any questions or comments, please put them in the chat box as we're going along. I will stop and mention those at appropriate points throughout the session. We're going to be going for about an hour, and Vince will take questions, like I said, during the session, as well as at the end. And the session will be recorded as well, and you'll get a recording of that. Vince, on that note, let's talk about long-term trading and leaps.
Sure, absolutely. So leaps, very interesting. Now, I do want to do a couple of things. Let me bring up my slide. First of all, trading can be risky, so please remember, don't trade with real money until you're completely comfortable with whatever system you are using. Now, as far as the presentation outline today. I'm going to start with the 3 strategies that I talked about in the free session last week that we had. I'm just going to go over them quickly for you just as a reminder, and that way we can use those as we go through the examples throughout the day. But I do want to focus on leaps. Leaps are long-term equity anticipation securities. In other words, just think of a longer term option. Regular call option, put option, can range from a weekly expiration, to several months. Anything that has an expiry 1 year or longer from now is considered a long-term equity anticipation security, which is a leap. Okay, so 1 year or longer is considered a leap. That's what we're going to focus on. We're also going to talk a bit about covered calls and callers, and talk about using dividend paying stocks, a couple of quick repair strategies, and of course, your questions are super important. Now we have a decent turnout here. A lot of people are on, so I'm sure there's going to be a lot of questions. So we want to kind of go through them as efficiently as possible to maximize our time. Raul will keep an eye on those questions and interrupt me as we go through. But this is what I'd like to cover today. So having said that, let's quickly start with the 3 strategies. And I'm going to start with the winning momentum strategy. Again, it'll be very quick. I know most of you are very familiar with this, but it involves 3 different indicators: the 20 period simple moving average, the Ichimoku cloud, but a stripped down version, that is just the cloud portion, and an RSI, relative strength index, with a slightly different setting. Now, the moving average, this is a 20 period simple moving average, and we are going to use it for the purposes of identifying momentum behind whatever move we'd like to trade. So basically what we'd like to see is a slope on that 20 in the direction of our trade. So if we're trading to the long side, we do want to see a slope. Something to this degree here, about 45-degree angle, that's what we would consider a significant slope on that 20, okay? The sharper it is, like you see more recently here on Netflix, the stronger and the more momentum there is behind that move. So the higher the slope, higher the degree of slope, the better it is for a long trade, and vice versa for a short trade. If we're looking for a short trade, we want a downward slope on that 20, okay? Now, the cloud, the shaded area here that you see, this is what we want to use to help us identify trend. And let me just go into the settings quickly to let you know that we do use the default settings, okay, of 9 and 26. We do not change that. What we do is remove 3 out of the 5 parts of this indicator. So these are the 5 portions to this indicator: the Tenkan, Kijun, the Chiku, and then Span A and Span B, which are the shaded areas here, the clouds. So we're going to leave Span A and Span B on, but for the other 3, we make them invisible. And on Thinkorswim, the way we do that is by highlighting one of the tabs here and making sure that this box has been unchecked, the show plot, okay? We want to make sure that's unchecked. On any other platform, you either go into the settings like this and mark it invisible, or one easy trick is to change the color of that particular portion to the same color as the background of your chart, and then it'll be invisible. You won't be able to see it. Okay. Lastly, and I should say that this indicator we use for trend. So if price and the moving average are both above the clouded area, the shaded area, that's an uptrend. If both are below, that would be a downtrend. And if one or both overlap the cloud, that's a consolidation area that we do not want to use this strategy for, okay? So the whole purpose of this is that we want to trade with trend and momentum on our side, and we want to be able to spot it very quickly. So whenever we bring up a chart, we automatically look at the most recent candle, the far right of the chart here. And so by using these techniques, we can, in an instant, tell whether there is a trend in place and what that trend is. and secondly, if we have momentum behind that move. So in this case for Netflix, we're clearly both above the cloud with price and moving average. So that's an obvious uptrend. And we have very significant slope upward on that 20-period moving average, which means we have momentum behind the move. So if we have both of those conditions, we now turn our attention to the last indicator, which is the RSI. And the RSI, what we do is we change the settings a little. Normally this has a default setting of 14. We're going to reduce that in half. We're going to put that to 7. And then normally what you'd see is an overbought, a line at the overbought level, which is 70, but we've reduced this to 50, okay? And an oversold line at 30, which we've made invisible. So normally you'd have 14, 70, 30. We want 7 and 50. And the oversold one, we go in here and we uncheck it and make it invisible. So that way we end up with a 7-period RSI and a line, a single line drawn right down the middle at the 50 level, okay? So when we put this together, what we're looking for is, for long trades, that is an uptrend, meaning price moving average above the cloud. We're also looking for slope so that we can say we have momentum behind that move. And then we're waiting for some sort of pullback towards that 20. And once we start getting a pullback, we turn our attention to the RSI. And we want to identify the candle that is associated with a cross from below to above that 50 line on the RSI. So you can see that during this pullback, the red line here, the red RSI line, moved below 50 and then crossed back above. So the candle associated with the cross back above, that is our setup candle. We want to identify that candle. Let me just zoom in here for a second. Okay, right here. Want to identify that candle as our setup, and then we mark the high of that candle. And if we get a trade 1 tick or 1 penny above that high, we can go long and put our stop just below the most recent low. Okay, and so that's our entry. And so you can see that it pulls back again and you get the same type of action. If you get multiple crosses here, that's okay. That's totally fine. In fact, when it does it twice, it usually leads to a much bigger move. Okay, and so the same rules apply. And then you follow it along. And a very simple and easy exit for this would be to trail it with, say, an 8-period EMA. And as soon as price crosses on the other side of the 8 EMA, you can get out. You can use the 20 if you want to give it more room. You can use a parabolic SCR, many different things. Okay, and the opposite is true for short trades. So for short trades, we'd like to see price and the moving average below the cloud. Let's see if we can see an example on a different time frame here. No, not on Netflix anyway. It's been trending really strongly. But if we were below the cloud with price and moving average, and we had a downward slope on that moving average, we get a pullback towards that 20, and then we'd like to see the RSI cross from above to below, identify our setup candle, mark that low, and if we get a trade below the low, off we go to the short side. Okay, so very, very clean and simple. Sam is saying, so the candle before the setup candle closes and is completely below the 20. No, it doesn't matter where the setup happens. So Sam, the setup can happen above the moving average. It could happen overlapping the moving average. It could happen below. It really doesn't matter. All we want to do is, once we identify that candle associated with the cross on the RSI, okay, we want to reconfirm that there's still an upward slope on the 20-period moving average. Because if this pullback went too far, if it pulled back even more, the 20-period moving average would start to flatten out and start turning lower. If that happens, we've lost momentum. So we get a pullback then we see a little bounce, and we confirm that we still have momentum. That's all that matters. Okay. Now, if we, and a couple other people are talking about the RSI. I'm talking about so we've got a couple of questions surrounding the RSI. First of all, we removed the 30 level. We only have one level at the 50 line. That's it. And the only cross we're interested in is for a long trade, we want the red line here, the RSI line, to move from below back to above that 50 line. And the candle associated with that matters. If we're looking for a short trade, it's the opposite. We're looking at going from above to below that 50 line and identify the candle associated with that. Okay. Now, to keep it or make it even more simple, what you can do on a monthly time frame is just use a 10-period simple moving average, okay, which is the white line here. 10-period simple moving average. What you'll notice, especially on a monthly time frame, is that price tends to remain on one side of that or the other of that 10-period moving average most of the time. In other words, there's very few spots where it will just sort of chop back and forth along that line. It'll either remain above it or below it. It's very smooth. And so an easy strategy to use longer term is just to make sure that you're on the right side of that 10-period moving average. In other words, if you're above it, then you're usually trending higher. And if you're below it, you're usually trending lower. So you can take the crosses from one side to the other. Okay. I would always make sure there's follow through. So in other words, you don't want just a trade below, you want to close below. And before you go short, for example, you want to make sure that that low is taken out, right? So if this is the first candle that closes below that 10-period moving average, you want to mark the low, and then once you get a trade beyond that low, that's when you want to short. If you want to be a little more conservative with it, you want to wait until the 10 starts sloping in the direction of the trade, okay? So sometimes when you have that slope and you get a pullback like we did here, it might go beyond that 10, close outside of it, and then back below it. And at that point is when you want to short. Okay, this is the S&P. So, for example, here we turned around, we started going higher, we pulled back again, and then we closed back above. Okay, so rather than getting in when the slope is against us, we get in when the slope is on our side. Okay, just to be a little more conservative. There's plenty of trades out there with this, so you can be very, very selective. Okay, so you want to pick the cleanest charts, the ones that have the strongest trend in place, and I would really focus on the ones where the slope is in your favor. Okay. Another question is, some traders use the 15 EMA, 50, 100, 200. Why would you not use these indicators? You can. I'm just telling you what my experience has been, what has been most consistent for me. And what I like to do is keep things as simple as possible, as uncomplicated as possible. And using one moving average like this is very, very simple and easy to use. Doesn't mean you can't combine it with other things. You can combine it. You can even combine this with the first strategy I showed you, right? You can use the cloud indicator. You can use the RSI and incorporate the 10 in there. Completely how you want to use it. I'm just giving you some tools that have proven to be very consistent. Lastly, another even simpler thing you can do to trade for the long run is just look for a break to all-time highs. So if we remove all the indicators from the chart, just leave price on, okay? Let's go to the monthly time frame. And it really doesn't matter what we're trading here. This is ABMD, but we can go back to the SPYs as well. It doesn't matter. The point is, you want to look for all-time highs. So if we go way back to 1999 here, you know, this stock was trading in the single digits, was it a $4 stock, made a bit of a run, went all the way up to about $41 and then pulled back. Okay, that was really the first major high it made. If we drew a line there at that time, okay, to identify that high, you can see that, you know, it took many, many years for it to get back there. Okay, some stocks will do it very quickly, others will consolidate for a long period of time. What this means is, this isn't a bad thing, the fact that it consolidates for a long period of time. It's actually a good thing. The longer the consolidation, means the bigger the move will be when it eventually breaks out. But what you want to do is identify a new all-time high. So back here in December of 2014 or January 2015, we finally broke out to a high we've never been to before, right? A new all-time high. And generally when that happens, obviously, there's a reason for it. There's buying pressure that gets it back to those highs. So there must be something good happening with the stock. But by not having any previous highs up here, it means there's no overhead resistance whatsoever. And so the stock has a clear path to move higher. Okay, there's nothing holding it down. And so at that point, it usually makes a run. So you see that once it broke 41 area, it moved to about 110 here. Actually, first one was about 75, then had a minor pullback. If we had marked those highs and then turned on a break of those highs, we went from 75 to about 110. We pulled back. If you mark those highs here, okay, off you go, and etc. You break the high here. Okay. Now, so what you're looking at, and the reason why this is as effective as it is because you're on a higher time frame, and there's no resistance up ahead. Usually, it leads to much bigger moves. Okay. So even though this doesn't look like much, as you saw, we went from the 40-ish area to about 75. Okay, it almost doubled in price, the stock. So these are very significant moves. And once you get in, you're still going to maintain a stop, etc. You know, you're still going to trail this to make sure that if it turns on you, you're not going to take a big loss, right? So that's the real key, is keeping your losses small, but allowing your winners to run. Now, it doesn't mean you have to be in it for the next 2-3 years. If it's chugging along like this, why not leave it and let it go? But you know, you can scale out along the way any way you want. Okay, using a tool like the fib extension tools, trailing it with an ADMA or anything you want, or just, you know, looking for a certain amount of profit and getting out. Very simple, very easy to use. You can combine all these. You can add any indicators you want, but in and of themselves, these work extremely well. And I tell you that from experience. I've used these methods over and over again. Okay. Let's answer a couple of quick questions, and then we'll go on to the material I really want to cover today: leaps, covered calls, callers, repair strategies, etc.
Juan was saying, Vince, do you consider volume as an indicator or for confirmation? On your SPY chart, volume remained steady during a run, then spiked when the trend reversed. Would volume changes precede or follow the move?
And yeah, so volume on a longer time frame, let me throw it on here, is very effective when you just look at for those spikes. So here you go. This is very typical. This is what we call the smart money buying. By smart money, we're talking about institutions, the big players. Okay. When you see a sell-off and you see a big spike in volume, okay, at least 3 times the average, and hopefully a lot more than that. Okay. When you see that, what that means, and the reason why there's a lot more volume than usual, is because all that selling is met with buying. Okay. So you have a lot of orders going through, and that is the smart money starting to load up on their position. So they start to buy here because this has gone far enough. For them, it's at a level where they think it's dropped far enough, and now they want to own some. So they start buying as much as they can here, and that's what drives it back up a little. They then stop their buying, and the sellers, if there's more selling to happen, will happen. It'll pull it back again, and you'll see another spike. What you want to see is that the second spike in volume is a little less than the first, but still more than average, and that the drop the second time doesn't come as far back as the first one. Okay. Once that's over, generally you'll see a big run. Okay. So that's the only way I use volume, is to look for the abnormalities here, these big spikes, not the usual everyday volume. Because during a strong trend like that, you should see low volume. It's just a nice, steady, predictable climb. That's all fine and good. And throughout this time, you want to be on the lower time frames, picking off the shorter time frame trades throughout that trend. Okay, but you can see here, just use basics of technical analysis, right? You dropped, you pulled up, you pulled back, but not as low. So now we put in a lower low, a higher low than before, right? And then as soon as we tip this point, you now have a higher high. So you've switched from lower lows and lower highs to higher lows and higher highs. That tells you you've turned the corner, okay? And now if you just mark those highs, and especially the all-time highs, up here, this was the all-time high, okay? And as soon as we broke that, there was nothing holding this back, okay? It pulled back a little, we marked this high. Again, when we clear that high, there's nothing holding it back, and you get a nice run. Very simple, very clean. Okay. All right. Raul, you interrupt me if there's any questions. If not, I'm going to move on to the next section.
Yeah, Sid was asking during your leaps discussion, can you focus on adjustments, when both the long-term call and short-term call goes down, or the long call goes down rapidly without a short call not following through? There was a question earlier as well. How do you manage leaps when the fundamentals of a particular security change? I don't know if you want to address that now or during the session.
Yeah, sure. So let's talk about it. First of all, you can certainly combine fundamentals with technical analysis. You can, especially with longer term trading. If you want to hold a solid company, a company with solid financials, that's great. But the two don't necessarily go hand in hand. In other words, what you see on the chart is impossible to predict from the financial statements. Okay, trading is called trading because it's a timing exercise. Trading is all about timing. Investing isn't. Investing is selecting a company for a particular reason and then holding it. Okay, two very different things. So you're not going to really worry about fundamentals when you're trading on technicals. Again, you can narrow your search. Like, one of the things I like to do is use the top 20 industry groups, right? When those are moving well, usually you get some really strong setups in there. So usually those are companies that are doing quite well at that time. But I no longer look through financial reports or anything like that. Many times I don't even know what the company does. I just look at the symbol and the chart. Okay. Now, as far as repairing leaps, let's first talk about trading leaps. What or when you want to use a leap. So if you're trading on a weekly or a monthly time frame, leaps are always a great idea. The most challenging thing with options is that you need to time the trade. So that time to expiration that you have is very important, and it's very much related to the time frame that you're trading. So if you are day trading a stock, say on a 5-minute, a 15-minute, even an hourly chart, you can, and you want to trade it with options, you can use the weeklies. You can go out, 5 to 7 days, maybe 10 days max, because you're only going to be in that order from a few hours to maybe a couple of days, not much more than that, right? So you don't need a lot of time to expiration, because the more time you buy, the more expensive that option is, and the more risk you have in the market, right? If you spend $3 on an option contract and there's a huge gap against you, right, because of news or any other event, you're at risk of losing that full $3, right? Well, if you're buying a weekly option that's only costing you 70 cents, then that's the max you can lose. So you want to balance the amount of time to expiration with cost, right? But on the flip side, if you're planning to be in the trade for months, right? If you're trading on a monthly time frame, so you could be in there a month to over a year, then you want to look at the leaps. And the leaps, as I said, are anything over 1 year to expiry. So in this case, we have the January 2020 leaps, 563 days to expiration, almost 2 years to expiry. Okay, that's really the only difference with a leap. Now, what you will find a little challenging sometimes with leaps is that the spread between the bid and offer might be a little wider than usual. You don't want anything crazy. Something like this is very reasonable. 75 cents to $1. That's totally fine for leaps. When you get a $5 spread, that's not really tradable, but about $1 is fine. And you want a lot of flexibility. You want a lot of different strike prices. Okay, so the active ones will have a tighter spread, will have several different option strikes, okay, which is important for adjustments, okay. And so what you're looking for, as always, just like you would a shorter term option, is you need to try to determine the size of the move you expect on the stock, okay. So if we're in a situation where, sort of back here, we had marked the previous high, right? So once we broke through that high, there was no resistance up ahead, right? So sky's the limit. So we can expect a sizable move from there. Now, this one was really great because this ended up being a cup and handle formation, which actually retested that level. I mean, this is as textbook as it gets from a technical analysis basis. But regardless, if you're trading all-time highs, sky's the limit. Now, you can use a tool like the fib extension tool to help you identify potential targets up ahead. So if we were looking for a break here, I'd use this low and this high, right? And plot my overhead targets, which in this case would have been right here, the 1272, the 1618, and the 2618. And you can see how easily and orderly this achieved those targets, okay? So based on that, we could have had a guess as to how far or how much room we were looking for, okay? So now, for example, let's remove this. If we use the same sort of concept here, we think this is going to break out to new highs, okay? Let's say it's right there, and we're waiting for this to break out, okay? Forget that it's down here. Let's assume it's right up here near the 51 level. We look to our left, identify the most recent low, recent high. Okay, we'll use this high because we want the major one. This is too tight. And these are our targets. So potentially, 51, 55, 60, maybe 72. We go to the option chain and we start looking to see, where those come in and what's possible. Now, a couple different ways you can trade them. You can simply buy a straight leap, just like you would a shorter call. You can just come in and buy a call. You can go in the money, but it's going to be more expensive. You can go out of the money since you're expecting a bigger move. That way it's less expensive. You can pick up more contracts. If it actually makes that move, you're going to end up with more money. Okay? You can do that, or you can actually buy the stock and buy a put that goes with it. That way you lock in your downside risk. You always have that option to exercise and get out at that particular strike, minimizing your risk, and then allowing the position to run. Okay, so here's where I want to talk about a few different things. Someone had a question earlier about how do you adjust leaps. So if it's just a single option call, so let's say that we thought XRT now was going off to new highs, and we came in and we had purchased, say, the 55s. Okay, we went out of the money. We had purchased the 55s. Okay, now let's say we had paid more for this. Let's say we had paid $5 for it, but now the stock has dropped. It's gone against us. The call's in at $3. And so we have the choice. We can just sell it, take a $2 loss. But we think that the down move is just temporary before it continues to go back up. So we still think that longer term XRT is good. So we want to try to adjust this long call. Okay. So how can we adjust this? Well, we can average down because it's cheaper, but that, usually doesn't work out quite well. A little safer way of doing it is that we can turn this into a debit spread, okay? And the way we do that is we go in, remember we have one long 55 call. We go in and we sell two of them. So we sell the one we own and another one, okay? So what we're essentially doing is if we sell two at $3, we're collecting $6, right? Remember, we spent $5, right? We're down $2 here. We sell, and let's use the real numbers here. We sell them at 2.5, let's say. So we'll collect $5 because we're selling two contracts, not one. And then we use that money to go in and buy a lower strike. So we're not putting any more money into the trade. It's the same money. We had paid $5, right? It's now worth 2.5. But instead of selling the one, we sell two. So that means we end up short the 55. Okay, we collect those $5 and we go back and we buy the 50s, one contract, right? For $5 here. So we've spent the same amount of money, but now what we have is one long call at 50, one short at 55. Okay. So now what this does is the stock no longer has to go above 55 for us to make money, right? If it gets back to 55, we've recouped our money because of the difference between the strikes. Okay. So of course the numbers have to work in your favor. It doesn't always end up that way. It depends how long you wait, how big of a loss you have on this strike for that to work. But what you're essentially doing is setting it up where if the stock recovers even a portion of the drop, it'll usually make back your money. Okay, because that's the real difficulty here is when a stock, you're buying out of the money to begin with, it drops even further, And so then for you to recoup those losses, the stock has to make a much bigger move in your direction. And of course, it has to do it before expiry, right? So what you're trying to do is lower your long strike so that even if it recovers a part of it, you'll make back your money. Okay? So that's one way of doing it. And there aren't a lot of options for you to repair just a straight long call. Okay? Of course, you can roll out, right? But if you're trading a leap, there's no further expiry. So you can't roll up and out, right? You could try to roll out again and pick up more contracts, but then you need an even bigger move, right? You can add more money into it, but why would you want to do that on a losing trade? Okay, so that's one option. It's a little easier when you own the stock and a put. So instead of buying that call, if we had bought XRT for say $49 here, and then we had gone in and paid another, $8 or so, 8.5 for the 55s. Okay, when you add these two together, 49 and 8, right? Your cost is about 57, but if we paid 8.5, maybe 57.5 or so, and that's where our risk comes in. The difference between the 57.5 and the strike of 55 is 250, right? Which is pretty much what the value of the call is. So our risk level is the same, right? If we buy that call here at $253, or we take on that risk by owning the stock and the put, the risk level is the same. But what the stock and the put do is give us more flexibility for adjustments, okay? Because that way, if the stock drops, first of all, the put's going to gain value, okay? And it's already at a higher strike, so at a higher delta, excuse me. So it's going to gain a considerable amount. So it's going to really give us a buffer for that loss. And then what we can do, a couple different repairs, is we can roll down in time, okay, to recoup some of that money. We can do a couple different things. Say the stock dropped and the put gained in value. We can sell the put for a profit, okay, and put that profit back into the stock, meaning average down using the proceeds of the put, okay, and then protect it with a different put and wait for the stock to go back up if that's what we thought it was going to do. Or say we sell the Jan 55s here, okay, for about $8 or so, 8 to 8.5, but we come down in time, right? The August ones, the 55s, right? They're only worth 6, right? So we recoup $2.5. So we lower our exposure, right? You lower your cost basis. You lower the amount of risk you have in the trade, okay? So you can do that to get out of it quickly, all right? Now, the other thing is that say you own the stock and the put, but the stock went up instead of going down. Well, what happens to the calls when the stock goes up? They increase in value. So somewhere down the line, you can sell a call against it and bring in much more premium. Really lower your cost basis and increase the amount of profit on that trade. That's what would be known as a caller. When you own the stock, you own a protective put, and you're short a call against it, a covered call. That is a caller trade, okay? But that's legging into the caller trade because you can put in the trade with all the pieces right from the beginning, or you can leg into it, which means you buy one portion at a time, okay? The reason why you want to leg into it is because if you're fairly confident that the stock is going up, why sell a call today when it could be worth much more once the stock makes its move, right? And Now, the benefit of putting it all on at the same time is because you have very little risk. Okay? So think about it. If we pay 49 for the stock, we pay 8 and change for the 55 put. So our cost is 57.5. We go here and we sell the 55 call, that we recoup 2.5. Our cost goes to 55, which is where we can exit the trade if we exercise the put. So we essentially have no risk on, right? We have no risk on. Well, if this was a dividend paying stock, this one happens to be, but it only pays a 75-cent dividend per year. But we have 2 years to expiry, right? So we're essentially going to collect about $1.50 in dividends. So now we have no risk, and we know we're at a minimum going to make $1.50 per share over the life of that order. Now, that may not be worth it for you to sit there for almost 2 years and walk away with $1.50, right? But the stock can make a big move during that time. You can rejig these options. You can do all sorts of things, right? And there's many other examples out there with stocks that pay a much higher dividend. Okay. The other thing you can do is just buy the stock and the put. Your risk is about $2.50, right? Well, if you're going to collect $1.50 in dividends, now your overall risk is $1. But over those 2 years, right, by not selling that call immediately, you're not capping the upside. You can let this run as much as it goes when your risk the whole time was only $1, right? And then if it does make a major move, you can sell a call against it and bring in a lot more than that. Okay, so a lot of different things you can do when you have time on your side. Okay, if you can't afford to buy the stock and the put, you don't have a big account. Okay, you can just buy the call, further out call. B, you can go in the money. You can do what we call a poor man's covered call, where you're essentially putting on a debit spread. You're buying a deep in the money call, right? And then you're selling a covered call against it. But it's going to cost you a lot less because you're only buying the options, right? So if you're buying 100 shares of this stock at 49, that would be $4,900 you'd have to put into the trade, right? If you're buying the 30 call at 19, that's only 1,900, right? It's only a fraction of what you would pay for the stock. So you can put on a similar position with less money, okay? But owning the stock and the put, if you have the capital, gives you a lot of flexibility along the way. All right. And now the other thing you can do when we're talking about the poor man's covered call is say we bought a deep in the money call here using the leaps. So if I buy a leap, or it doesn't have to be deep in the money, it could even be at the money, let's say, okay, or buy the 50s. Let's buy the 50s for about $5. And now we have 2 years to expiration. Again, if the stock makes a big move higher, at some point down the line, we sell a call against that and turn it into a spread. But we're bringing in a lot more money, right? So let's say that the 55 call was worth $8 at some point because of the move it made, right? I paid $5 for the 50. I sell the 55 at $8. I've immediately locked in a $3 profit, right? I've actually locked in more than that because of the difference in strikes, right? So a lot of different ways you can handle it. But the more time you have, the better it is. And the real advantage, I think, is the fact that that time using those monthly charts and using the techniques that I just showed you by trading at all-time highs or using that 10-period moving average, etc., is a very easy way to pinpoint those entries that allow you to take advantage of those bigger moves that happen on the monthly. And for some of you who trade for a living, right? You might think that, well, I don't want to place one order that could take up a good portion of my account, and then I have to wait 2 years to see some money. You know, you can just take a very small portion, right? What I like to do is trade mostly off the daily time frame. So I'll be placing orders all the time back and forth. But when I see a stock that's trending nice and strongly, looks really good, and is about to break out to new all-time highs, I'll just go back to the leaps here and pick up a few contracts far out of the money. A very small amount of money, a very, very small amount of my overall portfolio. And to me, that's an investment. I'm leaving it there, right? And I go back a year from now, a year and a half from now, and this could be worth a good portion of my account now. Could be a huge gain based on that movement, okay? And really, it doesn't take any of my time. I just go back and look at it once a month when that next monthly candle closes and decide, is it time to get out or is it time to stay in the trade, right? That's it. Questions?
Many questions, Vince. One of the big ones that keeps coming up is, how do you adjust for dividends and earnings with leaps?
I don't. Short answer is I really don't. So earnings, the gaps you see on earnings really only affect the lower time frames. I mean, if you look at a monthly chart here, and let's go to something that has gaps. I don't know. Let's first identify one. Well, maybe a Tesla. See, you're not going to see many gaps, right? Now, these bars might be wide, but you know, usually in the long run, especially when you have a nice strong trend in place, these earnings announcements have very, very little impact on the stock. You can see each one of these red dots down here, that's an earnings announcement, right? You know, if you're trading on the lower time frames, you got to be wary of them and worry about a big move against you and so on. But when you're trading on a longer term chart, everything is smoothed out, and you know they're really insignificant in my opinion.
Anu was asking, at what delta and for how long do you sell a covered call?
So that's the other thing. When you're selling a covered call, normally you want to go lower in expiration time. So going back to this example, if I were to buy, and maybe we should go back to XRT here. If I were to buy just a call, okay, and say I bought the 50s for $5, right? I could go down to the lower time frames and see if I can get any value here to sell a higher call. So I could say sell the $52 call and pick up 50, 60 cents, okay? My intent is to try not to get called away, try not to get exercised. I'm hoping that this expires worthless, so I keep my 50, 60 cents, I lower my cost basis, and then the next month I sell another one against it, right? And another one, and another one. But along the way, as long as the trade is going my way, I'm okay. I'm making money with my long call, right? And if there isn't premium, I'm happy waiting because at some point I'm going to be able to sell a call with the same expiration for a much higher amount against it.
Question from Fred. He says, how do you fix an in-the-money leap with a delta 80 with a protected put that goes against you? For example, Morgan Stanley MS is currently going against my leap.
Well, if you have a leap that's what do you have a straddle on? You have a call and a put, or do you own the stock as well? Because if you have an 80 delta call, and you say the put's going against you, Well, that's a good thing, right? Because the stock's going up, so your call is appreciating in value. And if your call is an 80 delta, your put should be a lot less than 80 if it's gone against you. So as the stock goes up, the put delta will decrease while your call delta will increase. And so you should be making more and more profit along the way. So
Uh, Sorry, Vince, the way I'm reading it, he says, how do you fix an in the money leap delta? It's a protective put strategy that he's got on, and the put has an 80 delta. So it's a deep in the money kind of put. And now it looks like MS is moving against him.
well, then the put's there to help you. So here's the thing: if you have it, that put is there for protection. So even if it's an 80 delta put, okay, and you own the stock, and the stock's moving higher, so the put is losing money. That's a good thing because you have a net 20 delta making you money. Okay, if the stock is dropping, the put is actually increasing in value, and the delta is getting higher and higher. So the lower MS drops, the more protection you will have with that put delta. It's not going to be 100%, but you always can exercise at whatever strike price you originally bought anyway. So your risk is limited. Now you have to decide at some point whether you're going to exercise it and get out at that strike price, or whether you're going to adjust the put option. Because the more value you have in the put, the more options you have. In other words, if you sell this at a profit, what do you do with those profits, right? So like I said earlier, you can go down in time, right? Because that same strike put is going to cost a lot less. So if we look at MS here and we're looking at the leaps, the 60 put is worth about $14. If we go to the July 60s here, it's worth, yeah, a little 13 or so, but a buck less. Not much in this case, but usually you can capture a difference there. Okay, but if it's there for protection and the stock is going against you, then the put's doing its job. And so the best thing is you may need to just exercise it and get rid of your position at that particular strike, which is why you set it up in the first place, right?
So I think he's clarified a little bit. He's saying that it's actually a call that he has with a delta 80. And because MS is now moving down, that leap is starting to lose value quickly.
Okay, so then you don't have a put, you just have the call. Yeah, well, so two things. One, you can turn that call into that debit spread that we talked about. So if you have the delta 80 call, I mean, if you're deep in the money on that call and it's going against you, if you have any sort of profit, I'd basically take it and run. It's hard to imagine you're at a loss with that just yet, but if you are, yeah, you can turn it into a debit spread, but it doesn't work as well with the in the money amounts. Always look at your chart and determine if the trade is broken, right? If there's a reason to exit here, then just exit. There's not a lot of different things you can do with a deep in the money call. You can sell a higher call against it, right? Turn it into a debit spread. That way you're bringing in some premium and lowering your cost basis, but it depends how long you've been holding it, what point you bought it, and how much of a loss you already have on your hands. That might not make up for it. So I'd have to know the numbers behind that trade. Sorry, I'm trying to help you as much as I can.
Let's go to Sal next. He says, Vince, how did you go about selecting the proper strike for the put against the stock ownership? So how do you choose the strike for a protective put?
By the amount of risk that I'm willing to take. So there's two things involved. First, I want to make sure that my net delta is still big enough for me to make money off the trade. So if I'm going to buy this at MS at 47, for example, and I go out to the 80 strike here, it has a 90 delta almost. That means I have a net 10 delta, not good enough. So I want to come down and maybe look at the 60 strike max, 81. That'll give me a 19-20 delta. I'm okay with that. But the other thing is that when you add the cost of the stock and the put together, minus your strike price that you can sell it at, what is your risk? Usually, if you look at the call column, that's the amount of risk you're taking roughly. So if I'm buying the stock and the 60 put, minus that 60 strike, and I have less than a $2 potential loss, but I have a net 20 delta or more, that's the kind of setup I'm looking for. So I want the least amount of risk with the highest net delta I can get. That's the balance. Okay. So the lower I can go, the better, but usually it means more risk. So I need to find that balance, low risk with enough delta.
George says, Vince, are there certain stocks when you look at their charts are more ripe for leaps or long-term trading?
Well, the ones that, like I said, are making new all-time highs because there's no resistance up ahead, or the ones that are recovering, like we've seen Cisco or Intel recover. You know, it got beat up big time after, the dot-com fiasco, right, in 2000, and then kind of went sideways, right? Now recently, after moving above all, the highs here, and that's where it started to move, right? After it cleared all that congestion here, it's got a clearer path. But obviously, if this was an all-time high, it'd have even more room, an easier time going higher. So that's really what you want to look for.
Let me go to Kofi next. Kofi says, Vince, which delta to buy for your leaps call and which delta for your protective put?
So again, the protective put, we just explained that it's a balance between the amount of risk you end up with versus the net delta, okay? And when you're just doing a single call, you want to look at what the potential move is on the stock, right? How much upside is there? And again, how much risk do you want to take? So, if I went in the money on this, to get a 70 delta, so that for every dollar the stock moves, I make about 70 cents on that. It would cost me about $8 a contract, right? So I have $8 of real risk on the table per share. But if I go out to the 50s, my delta is lower, right? It's only a 31, but my risk is considerably lower as well. It's a little over $2. So I want to balance, again, between the amount of risk I'm willing to take and getting as much delta as I can. And so if I'm going out of the money, though, I got to make sure that the stock has the potential to one day be in the money, right? So here we have very few strikes to select from, but in some securities, you have a long list. So, but it's always a balance between risk and potential profit with that delta.
Ash says, Vince, do you ever consider condors and butterflies? I know the answer is yes to both, but how do you?
Under very limited circumstances. So iron condors, I hardly ever do. The only time you want to look at an iron condor is when you have a very clean channel happening, right? Stock is moving sideways within a very defined channel, very defined trend. And this isn't the cleanest example, but you know what I mean? If it's in a clearly defined channel and you think it's going to remain there, then you want to sell a call credit spread up here and a put credit spread down here and hope that everything expires worthless and you get max profit. Very tricky to do, very difficult to make money at it longer term. Butterflies, again, they're great because they carry a very small risk and big reward, but under very limited circumstances. And I usually do that on a much shorter time frame, usually 30, 40 days out, not much more than that, maybe 45 in this case. But what I look for is one particular strike to really stand out with the amount of open interest, right? So if, let's say, the 44 strike had 20,000 contracts of open interest, but everything else, had 2 or 3,000, that's where I'd want to put my mid strike on the butterfly, right? Because usually the stock will close on expiration right near that level, and that's where you'll get max profit, right? It's called a pin play. But basically what you're looking for the butterfly is your challenge is you have to guess what price level the stock is going to be at expiration. So if you had some way to know that it was going to close at 45 on expiration, then that's where you want to put your butterfly spread at 45. But knowing exactly where it's going to close is the challenge. And, none of us have a crystal ball. So it's a very difficult thing to do.
Spiros says, Vince, is there any more value in buying leaps and locking that money for a year or more than getting a 3 to 6 month option and readjusting as the stock moves? That's a great question. Thanks, Spiros.
Yeah, it comes with if you can get an inexpensive contract, right? And the stock makes a huge move, this could really, really help you. So there isn't really, I mean, time is an advantage. Okay. First of all, when you're picking up a leap, you're going 2 years out, the theta decay on that time value is going to be so slow you're not even going to notice it, at least not for the first year, right? So very little decay time value wise, but the back and forth that happens on the daily chart that could stop you or cause you to get out of a trade, right? So a pullback like this on a daily chart will definitely get you out of that trade. You'll be going along and now you think, well, this trade's definitely broken. This is turning around. I got to get out. It'll trip your stop no matter what. On a monthly chart, that's not going to trip your stop, right? So you avoid all the back and forth and it allows you to remain in that order for a bigger move as long as the overall trend remains intact. So it's easier from an emotional standpoint to stick with, okay? It's nowhere near as time consuming, okay? And the reward is potentially huge because of the move it can make over the next 2 years. The flip side is if you tie that money up for 2 years and it doesn't go anywhere, yeah, that's a problem. But that's why I usually focus on the very inexpensive contracts. So I'm not going to worry about $1.50 or $2. But in 2 years that could be worth $20, $30 a contract, and that's the difference.
Rosemary says, Vince, how do you determine if a leap that you've invested in is a good trade? How long do you, after a purchase, a leap, does it have to show profit immediately?
No, it doesn't have to show immediately, but you want to use the same techniques that you would use on another time frame, or use the ones that I spoke about earlier. So if we use our winning momentum strategy, right, and we look to get in on a trade when all the indicators line up, you do the same thing, right, on a monthly chart, and you'd set your stop as well at a certain level. And if you get stopped out, you get stopped out. But using the leaps and that longer term expiration gives you more time for that move to work out. Sometimes you get in an option and then it just kind of goes sideways for a few weeks, right? And the theta decay takes over. You start losing money on that shorter term expiration. you end up exiting because you're almost out of time, and then the stock makes a move, right? Options and trading in general is about timing that move, right? Having a longer term expiration allows you to be in there, and your chances of capturing that next wave of the move is much higher because you have a lot more time to sit in the trade. Okay. Um, but again, do what's comfortable for you. You don't have to. You can use the same principles on shorter time frames. Um, but if you don't have a lot of time to devote to this, the longer time frames are fantastic.
All right, Guillermo had asked this question earlier. Just quickly, what do you mean when it's above and below the cloud? Guillermo, we have a course that we can send to you as well. You can send an email to us. We'll send you a full course on the cloud as well.
Mm-hmm. Yeah.
All right, Vince, it's just about 10 minutes past the hour. What do people need to know before they walk away from this session?
The key is to get familiar with either, just some of these concepts. You don't have to use them all. There's a lot here. The session's recorded. You can go back, listen to it as many times as you want, but take it slowly, take it one step at a time, get familiar with one aspect before moving on to the next, but do what's comfortable for you. The reason, I talked about 3 different strategies. They all work. They're all good. You can even combine them. It's what you're comfortable with. So, the easiest thing is start off with nothing on your chart, right? And just look for those new all-time highs. Doesn't get any easier than that, right? So, for example, here on the Dow now, this would be the all-time high, the 26,608. So you mark it and you wait. And if at some point price crosses it, there's nothing overhead preventing it from going higher, and it's most likely going higher. It's that simple. If then you want to incorporate the 10-period moving average, or you want to incorporate the winning momentum strategy, whatever, by all means, but take it one step at a time. Get very familiar with one aspect before you move on to the other. Okay. And remember that when you're trading, the first thing that you should always take care of before you get into an order is the risk element. Okay. Always identify exactly how much risk you have on the table. What's your worst case scenario when you get into a trade, right? What is the absolute worst? Don't go on probabilities, right? It's, before 9/11, who would have thought that we would have had a 9/11, right? I don't think any of us did. We weren't sitting there hedging just in case. We never thought it was possible. Well, it happened, and it can happen again. So always think of the risk element. And if that worst case scenario is you're still comfortable with that, you can move forward. Okay. And of course, have your money management plan. In the free session, I gave you my money management rules. You should have the recording of that. Go back and watch that and make sure you incorporate that into your trading plan.
It's a busy session. Still have a lot of questions that were unanswered. If you want to email those into us, folks, info@tradingwins.com. We'll do our best to get to them. As Vince said, this was a busy session. We're glad you could join us. Vince, we do have I did want to make one announcement, is that we have our end of the year annual conference coming up. If you go to tradingwins.com/early, if you can show that page, just let the folks know what it's all about and how they can get it.
Sure. So every year we have an annual super conference event. Happens near the end of the year. This year it's December 1st and 2nd. It is a weekend. That is a Saturday and Sunday. And we have 2 full days of training. The agenda hasn't been finalized yet, but I will finalize that soon for you. And, we've done this live in person in the past. This year, like last year, it's going to be an online event, 2 full days online. So there's no travel involved, nothing like that, but 2 full days of training with me. And as an early bird special, you can get it at a discounted price at $397. If you want to take advantage of our membership, our pro membership, and take an annual membership, you'll get the annual membership and the super conference for the early bird price of $9.97 as well. We do have a separate page set up for our super conference, just to give you an idea of what we did last year. So if you go to tradingwins.com/SC18, short form for Super Conference 2018. So tradingwins.com SC18, and you scroll down here, there is last year's agenda here, the 2017 agenda. We're going to leave that up for a little bit, and then we're going to put in the 2018 agenda. So you get an idea of what we do over the 2 days. A lot of content there. And as Raul said, if you go to tradingwins.com/early, you can take advantage of the early bird special.
All right, we'll have this recording out to you by tomorrow. Hope you enjoy it. Hope you enjoyed the course. Juan says happy 4th of July. Let's blow something up. Great idea, Juan. We'll certainly look into that. Vince, any last words before we sign off?
No, happy holidays. The markets are closed. They're going to be closed tomorrow. Enjoy the time off. All the best to you and your families, and we'll see you next time.
That is our long-term trading and leap session. We hope you enjoyed it. Today is the 3rd of July, 2018. Vince will be back with his regular update on tomorrow. Tomorrow at around 2 o'clock Pacific time. We look forward to that. Our next market chat for our pro members is Thursday morning, 10 a.m. Eastern, 7 a.m. Pacific time. We hope to see you then.
Thanks, everyone. Take care.